Hello everyone and welcome to Jim Dalton's presentation on signature trading opportunities. It's April 22nd, 2015, 11:30 a.m. Eastern. This webinar is being recorded and will be posted to J. Dalton Trading about an hour after we are completed. And please type your questions in or email us after if we don't get to them. We have a full house, so it's difficult to accommodate all questions, but we do want you to have them answered, so reach out to us with phone or email if necessary. And thank you everyone for being here during the trading day. It's great to see you all. Jim and I appreciate it very much. And with that, I will turn it over to Jim Dalton. Hello, Jim.
Good morning. Okay, I should be looking at the report. Do you have the report up on your screen?
Yep, let me just move it up there. I guess I could have done that before. Okay.
Okay. What we're starting with, this is on our signature trading opportunities. We have some slides. However, today gave us a perfect example of one of those signature trading opportunities. What you're looking at in front of you is the S&P morning report, the first page of it that goes out to clients. Right now, I only do it for a couple of institutional clients.
And Jim, if I may, excuse me, if you did not get this report, you can go to J. Dalton Trading. This report and last night's recap and preparation report and the presentation slides are available. So go to jdaltontrading.com, resources, webinars, upcoming webinars, and the top webinar will have 3 links there for you to download the reports to help you with this presentation. Okay, thank you, Jim.
Okay, this is, once we start, for those that sign up for the intensive, once we come to May 1st, this is a sample of the report you will get. This one is actual for this morning. So I'm just going to kind of read it. We remain within a tight 37-day trading range. Current trade location is shown in the above graphic. So you see we're up near the upper third of the low confidence trading range. The last trade shown is of 8:30 Eastern Time. Is at the low of the 2-day balance. Apply balance trading rules to the 2-day balance. 1, remain within balance. The expectation would be for a rotation towards the upper extreme of the balance. Look below the balance and fail to attract sellers, seeing price return to balance. The upper extreme once again becomes the potential destination trade. 3, look below balance and accelerate lower. 2075.50, which is a remaining lower prominent point of control, would be the potential target. So that was the report that went out this morning. Now, Julia, if we can show my screen. Julia, you there?
Yeah, I was going to say, you'll tell me when you want to show the other screenshot.
No, that's what I just said. Oh, just, yeah, yes, I will. Thank you.
Okay, thanks. There you go.
All right. So what we're looking at now is my screen that's live. The opening is the green dot.
2095.
2095 even. The market began to trade off rather aggressively. The first thing you will notice is the B period low went to a single tick above yesterday's low. This is, one of the observations that I have been making so consistently lately as one of the most important, I put so much confidence on this now, one of the most important discoveries I've made in 10 years. Once this comes down and tags a tick above yesterday's low and bounces, and it bounced to about half back. Half back was a little higher at that point in time because we extended lower. At that point in time, as a day trader, that is a high odds short because you're coming down. This low is probably no good. There is no excess on the low at that time, as well as it's being a poor low because it is only a single tick away from yesterday's low. So it's a poor low because there's no single, at the end of B period, or I'm sorry, at this point in B period, when it touched the A period low and bounced, there was no buying tail down here, so it was a poor low. Additionally, it was a poor low, and additionally it was a weak low because it was a single tick from yesterday. So in two cases, it had high odds of being revisited and taken out. So that's where we were. So what I see as a daytime frame trader, as soon as that market bounces off of this low, I think that's a perfect short. Okay, now the market B period comes down and does take this out as expected. Now once this takes it out, I went to volume, and we're going to go and show you the volume. This is on our trading site, and this is also available. Julia can give you a link, show you how to get it, or it's also available on our site.
It's not available quite yet on our member site, but
Okay.
someone's coding it, one of our traders,
Okay.
a fellow
Okay.
trader to you guys, so yes.
Okay. Now, the first thing I looked at, volume for the first 30 minutes on the way down was 387. That's down from yesterday, which was 410. When I look at this being down 387, I know, because I watch this every day, I know 387 is very low volume.
To commensurate with the move, too, you're also thinking how A had a lot of single prints, right?
No, exactly what I was going to say next.
Okay, thank you.
So I know overall that it's very low volume. High volume would be someplace in the 475, 5 1/4 range. Yesterday was 410, so we're down from yesterday. We're at the lowest end, about the lowest end that we get to on this number. Now, on top of that, let's go back to the profile. On top of that, I had all of these single prints. So when I combine that, that tells me that I have liquidation by the short day and short-term traders rather than any new selling by the longer-term time frames that can have more influence on a market. So that is a tremendous amount of information to take in and process. Knowing that this low wasn't any good, or at least thinking the odds were very good, it wasn't any good. The bounce, perfect selling opportunity. The low volume this morning tells me there's not likely to be a lot once it takes that low out. So now, Julia, can you show the IM I sent you would have been at 10:12 Eastern Time?
Yep. I just have to go to webinar.
And I'm trying to make this as real as possible. It's not my habit to show you trades, but I'm trying to give you a feel. Okay, let me know when that's up.
Hold on, Jim. Let me take it back. Okay. Can you see it okay? Yeah.
Yes.
I'll make it a little bigger.
That's okay. Now you see right in the center there, which would have been, that's 10:12 Eastern Time, sold my puts and bought calls. Volume was lousy on the break. And Julia talked back nice. I said, we don't know that yet. Okay, let's go back to my screen. I just want to put these pieces together. Okay, let me know when we have my screen back in sight. Okay, so now the price at that time was,
Jim, before you go on, your screen is smaller. Are other people seeing Jim's screen as, can you maximize it? No, your entire window, not the window trader. It's not taking up the whole screen, but maybe it's just
It is on mine.
Okay, great. Okay,
Yeah,
pardon
it
me,
is
everyone. I just want to make sure it's as big as possible. Thank you, Jim.
No, I'm sorry. It's taking full screen on mine. So now, whoops, make it small. So now I am selling my puts and I'm buying calls. Would have been someplace right here. I mean, people want to know, well, what exact price? There was not an exact price. Price was not in my thinking when I did it. I was looking. There was a lot of single prints this morning. The volume was low. It didn't feel like it had the confidence. To me, it looked like a worthwhile trade to sell the puts, and I'm within the balance. I'm within the balance. So I've got two things. Either I stay within the balance, which case the objective would be to rotate back up, or I look below the balance and fail, which case the objective would be to begin to rotate higher. Okay, so now as I set back to the I am to Julia, we don't know that yet. Well, the market it rallied a little bit, came back down, and it took out the 2-day low. And once it took out the 2-day low, that was it. So this was the perfect signature trade. When it doesn't quite get to the 2-day low, which happens quite a bit, it just rallies up. It's still a low risk trade because you get out if you start getting acceptance down here. This is a better trade once it looks below the 2-day low and comes back in. And that is a classic signature trade that we talk about all the time. Now,
we had it on Monday in crude too when we were at the webinar in the morning. It was an inside bar, but
it was an inside. We had a 2-day balance. We had a 2-day balance on crude on Monday, and it came down. It did not take out the 2-day balance. It failed to take out the 2-day balance, but it did rotate up to the top by the end of the day. So what you're looking at here is a combination of trade location. You know fairly quickly if you're right or wrong, and you have an opportunity to rotate back towards the opposite extreme. So again, balance, excess and balance are the two most important concepts that we deal with. This has two. It looked below balance and came back in, and we also have excess on the low. So this is the ideal trade. It happened this morning. Now, the one thing I will add, there was some volatility in here, and I understand that price is scary when you see this coming down as much as it was coming down. What gave me courage was the volume was low, and the fact that the B period tagged exactly one tick above yesterday's low before it bounced also confirmed to me that if I had really strong selling from other time frames, it is highly unlikely the market would stop even once at a single tick above yesterday's low. When I see that happen, that is more an indication that I'm dealing with day and shorter term traders, not the more feared longer term participants in the market. Now, down here there were people that are always asking, and well, what calls did you buy? Well, in this case, I just happen to have them in front of me. I bought the 2095 calls that expire this Friday, and they were $440. So that's $200. They were $220 a piece. One of the things that I told Julia, I said there was a lot of volatility in there, and I must admit, price scared me a little bit. And I said I'm not sure how easy it would have been to do this with futures. But anyhow, so I've walked through the first of our signature trades. I've walked through a couple of short-term trades this morning. One being as soon as this market bounced, leaving this poor low, weak and poor low. Understand the difference. Weak low because it is a single tick above yesterday. That's a weak low. Poor low because there was no single print buying tails no buying tail, no excess at the time, and the market rallied from there. As soon as it rallied, it looked like an opportunity to be on the short side of this market. Now, this is not a trade I did. I didn't do this trade because I was already positioned in the market. But had I not been positioned, this is a trade that I would have done at that point in time. It's a neat little day time frame trade. And one of the things that I continue to talk about is being in front of the screen and paying attention, not sending out emails, not telling your best favorite jokes, and not, not doing other things that distract you. I just got done reading a book by one of our clients who's a well-known trader, and one of the things that he says is, you get a lot of points for just being there, and I think that was an extremely astute statement. You get a lot of points for just being there, and that's exactly what I've been saying. And so many times we miss those opportunities because we're not engaged in the market, or because, we lose interest in the market. Almost every day there will be some kind of good opportunity. Now,
and he also says, excuse me, Jim, being present too. You show up and
well, that's what I meant. Is that not what I said?
Focus.
I'm sorry.
No, you said being there, but being there, of course, showing up, but then being present, being focused, and really focused, absorbed. But you've been saying that for years. But anyway, that's it.
And as we said years ago, I had a educational tape series called "Operating in the Present Tense," and everybody sent me Michael Jackson's book, who was the coach of the Bulls, because he
Phil Jackson, yeah.
Phil Jackson. I'm sorry. Julie is here to correct many mistakes I make. I'm like George Bush in a way. But anyhow, Phil Jackson, and that's what he was talking about. Why were the Bulls a good team? Taught them to operate in the present tense. It's what you've got right now, not the last game, not going forward. Now,
Jim, can you shut excuse me, before you start again, can you shut those time templates? It's a little distracting. Just to know the far one. Thank you.
Okay. Now, the next piece before we move on. D period high from yesterday. D period high today is 1 tick short. The odds are that we take that out. That is another, incidentally, it's not exactly one of the signature trades, but it should have been. One of the signature trades we talk about is when you have a trend day, and this is currently developing into a trend day, when you have a trend day and you have a poor high, more than likely you get continuation. It takes it out, falls back, takes it out again. At the time we were doing the signature trades, we weren't focusing on weak highs. So this is a good high because there's single prints, but it's a weak high because it's only a single print away from yesterday's high. So the odds are pretty good that this gets taken out before the day is over. Okay, before I go on and move on to the other things that we have scheduled, I will take any questions just based on what I have talked about to start the program this morning.
Do you have any projections, excuse me, for the bounce that does occur, say the B period bounce? Do you ever have any targets on the bounce?
No, I do not. Oh, well.
Did Jim have a reference where the bounce might go?
Absolutely not. But it did go to about half back. It went to almost, I don't remember exactly, but I think it went to half back or a tick below half back. If anybody out there that saw it, but the best trade is when it goes to half back. But I'm not that exacting. One of the things that I continually say, exactness kills. Too many times traders are so intent on being exact that they miss the trade. If it goes to an exact reference, it may not be a particularly good trade. For example, down here, had I tried to be exacting down here when I sold the puts and bought the calls, who knows if I would have gotten the trade done. Exacting wasn't even in my thought pattern. It looked to me like a good opportunity, and I took the opportunity. I went with calls. Like I say, they're $440, which is $220 a piece. So I controlled risk that way, but it certainly wasn't exact. If I'd been looking for exactness, I said, well, let's see if it takes this out. If it takes this out, let's see if it gets accepted back above it. There's an awful lot of things. Sometimes you have to make a decision based upon the information you had. The basic information I had this morning was the greater number of single ticks, the low volume in the first half hour. I told me a pretty good idea that the market was more emotional selling than the more feared longer-term participation. Okay, another question on what we've talked about so far.
Yes, D references from 2 days ago. You had said yesterday, just to make that clear, and everybody, they're just saying, you know, the D, we're one tick shy of Tuesday's high. I mean Monday's high, not Tuesday's high.
Oh, okay, I'm sorry.
Okay, yep, just so, thank you, everyone.
I'm sorry. I shouldn't have. Thank you very much, because that takes this away. This is not a weak high. Thank you very much. Thank you very much.
Yep,
This is a good high. That was totally wrong on my part. The next reference would be the B period high to get into this excess. No, thank you. I was absolutely wrong. Thank you very much.
Jim, also at the very beginning, before we started, we had a gentleman ask, what is short covering? Let me get right up to you. Let's read it. What is your definition of old business versus new business, or what makes up old business, and what is considered new business?
Okay, it's old business is very simply liquidation. In other words, people that are already wrong that have liquidation. Old business is short covering. People that were already short and have to cover. They're covering old positions. Liquidation, they're covering old positions, getting out of old positions. So it's old business. It's people getting out of trades that they had currently be in.
They're buying to cover, not buying to initiate a position.
They're buying to cover, or they're selling to exit. Now, let me go back, since I've been corrected, and thank you very much. This is not a very good situation right now, because the DE period match. So this is very mechanical. Very mechanical buying right at the D period high. So it is
a D period low.
D period low. So it is not a particularly good situation. The odds are somewhat improved that this will be taken out before the day is over. It's only one data point. Nothing more than that.
Okay, Jim, and we had some questions. I know you and I talked about possibly replaying this morning in fast time on my machine, but we've had a couple of questions to recap that early trade. It might help to do the replay, but that's your call. We can keep going, but I'm just throwing that out because there is a question to recap.
Go ahead.
Do you want me to replay it?
Sure.
We'll do it very quickly, everyone. Just make this real. And let me just get my screen showing. Okay, I'm going to start playing the day here. Can everyone see my screen? I guess you can, right? It's so many questions coming in. Okay, are we ready, Jim?
Yes. Why can I not see your screen?
I don't know. GoToWebinar's acting up, I think. It's... Okay,
there, I've got it.
You do? It's just small. It's small?
Yeah. Yeah.
Shouldn't be.
Yours is tiny from what I'm seeing.
No, you have to adjust it on your window.
Okay.
In the upper left corner, go full size. I was doing that before. Okay, so here we are, everyone. This is overnight trade. Let me get rid of that time template. This will only take a second. What we're using here is Window Trader Blue Market Profile software. If you don't have a profile solution, at our site, Resources, Market Profile Platforms. There's a bunch there for you to check out, but this is Window Trader Blue. Jim, you ready? I'm going to start playing the open. Okay, this is at 30 speed, so we're just going to ramp through this pretty quickly.
Now stop it for just a second. As Julia said, this is at 30 speed, so it makes it look like it's going very fast. Can we get rid of those time templates?
Yeah, I had to stop it. When I stop, I have to open. Go ahead.
I'm sorry. So when you're playing at 30 speed, you don't see how slow this was moving. That actually was another thing that factored in this morning. It was, even though there were a lot of single prints and it went lower, it was grinding as it went lower. Okay,
that's a great thing. That's confidence, and we talk about that a lot in the intensive. Just how it goes down can give you a clue where it's, you know, how likely it is to have downside continuation. If that isn't short covering, I don't know what is. When it popped like that.
Okay, stop right there. Okay, now, so now you see that low we were talking about. It was a single tick above yesterday's low. So now we're going to watch the bounce. Well, we haven't started B period yet, but that was the A period low, okay?
So it bounces once from there, so it's suspect.
Yeah, it is already. I'm sorry. Before, let me stop again. I may have given you bad information. Once it bounces one single tick from here, I think I told you. Once it bounces one single tick, leaves this hollow. This is the rally. It's the B period rally I want to sell. I think I told
because
you wrong.
you were saying the B period low, so it must have bounced in B because you were talking about a structural poor low too.
No,
but it bounces first.
Well, I may have been wrong. My memory may have been wrong.
Okay, so let's just.
Yesterday's low, or the A period low is a single tick above it. It's this bounce that I want to sell. So I'm sorry if I told you wrong. It's the bounce in A period I want to sell. Okay.
Same concept.
Let's see how far B period goes.
It goes 3 ticks above half back, okay. And now we have a poor low and it bounces again. So okay, then it very much. Okay.
Okay. There it is. Okay, so that's so that A period. I didn't realize it bounced that far, but that's that bounce in A period that I wanted to sell. Now we're down. We're still playing this. We haven't taken the low out yet.
And now you sent me that I am at 10:12. It's 10:14. So you were in right now.
Well, yeah, I was already in, and I was in before it made that low. Okay, so this is. I think we can stop. I think we can stop right
Okay, I'll give you the screen back.
Yeah, this is what you saw. What was good to see, and I'm glad we did that because I was absolutely wrong on the B period. It was the A period bounce.
It did bounce in B too, though, but it was the A that triggered your
the B period bounce was just very limited. It was only
really tough, to get in there. Okay.
Yeah, three or four ticks.
All right, and we have questions, we have slides we haven't gone through yet, Jim, with the overnight inventory. So I don't know where you want to start.
Well, any more questions we have on what we've looked at so far this morning, because this is real today and it's right in front of everybody. So if there's a couple more questions, I'll go ahead and take them.
Okay. Wouldn't you have considered yesterday's, if you could point to this, Jim, B period high as a weak high, because it was 1 tick above the Monday high? Could you point to that, please?
No, I wouldn't have.
And can you slide your profiles over so we can see more of what's gone by in all that blue space? Yeah.
I wouldn't have considered. It may be, that may be right, and that's what it's looking at this morning. But the only reason it would have caught my attention is there's all single prints above here.
But he's correct that he can carry that forward. But yesterday the overnight inventory was all long, and what we were seeing early in the day was the liquidation, correct, Jim, of overnight inventory, and it just wasn't.
That's in the charts we're going to talk about in a little bit. I think this morning's inventory was, when I wrote the report this morning, it was pretty neutral. By the time we opened, overnight inventory was long.
Right. Okay. So, do you want to go to the slides to talk about that, or?
No, I will in just a second,
okay.
Just unless there's one other question from anybody in here.
Okay.
Just a couple.
How many points do you normally have for your stop? I know it depends on the day and specific situation. I just want a general idea. Is it more like 2 to 3 points, 4 to 5, 8 to 10? Go ahead.
Not a clue.
Well, we wouldn't be taking a 4 to 5 handle stop, or even maybe 2 to 3 points in the S&P stop. Sometimes you try and get it even tighter, 6, 8 ticks. Sometimes it's even tighter, when it's busted, but we really wouldn't. I can't see it going 4 handles for a stop point, because we'd want better trade location than that.
My concentration is on trade location, and the most important thing to me is, if I'm going to have a stop, where am I going to have that stop relative to trade location? If you get poor trade location, the only time you'd have a 4-handle stop is if your trade location was absolutely terrible. But that's that's for another day. But the whole thing, the whole thing is really on trade location. Now, for example, when it looked below the low this morning, the 2-day low, you get two types of stops. You can price stop, which was probably just a point or so below this, because if you get down there again, you're probably going to get acceptance down there, or a time stop. And the time stop is actually more important, because what you want, once you look below this low, you want this market to get back up in this range. Then, when I was watching this, I wanted it to get 3 wide. The reason I wanted to get 3 wide, that lowered the odds that I was going to come back down here. I was getting acceptance up here, and I wanted 3 wide, and I got my 3 wide. So that was my time stop. And when I'm using an options, I don't have stops. Part of the advantage when I use options is I don't have to worry about stops. Had I been trading this with futures, I think I'd have been more nervous. I made some comment about that earlier, and commented Julie. It was much easier for me using the options, knowing that I paid $440, which would be $220 a piece. So that was my total risk per option. Yeah, you could lose all of it, but it wasn't going to be devastating. Okay, one final question, and then let's go forward. Julia, one final question, and then we'll go forward.
If you shorted A period, he didn't short A period, B had opened by then, would you not have had to leave a generous stop or even no stop? Or what would be the reference to know the trade was, the short was not going to work?
Somewhere above half back.
B went 3 ticks above half back, Scott, so if you were using half back, it might have come close to stopping you out, but there was a lot of volatility this morning, and 3 ticks is tight on half back.
I would never put it 3 ticks. I'd probably put it at least a handle and a half above half back. I mean, it's just that. But remember, one of the important things is that I very seldom get taken out by a stop. One of the important things is that if the market's not giving me what I want, I'll exit the trade. Okay, let's go on. Let's go on to the regular slides.
Yeah.
What we talked about today is clearly a signature trade. You saw it was written up before the opening this morning. You know that was a real report. It's the kind of report you will get if you're a member of the intensive. And we walked through several opportunities related to how this morning traded. I think the biggest single piece of information in my mind was the volume being so low with that many single prints. I'm like everybody else. I'm never certain about any of this stuff. But the volume gave me the confidence that there really was no serious selling on the downside this morning. Okay, I'm going to minimize this. And I'm going to go to the slides that we have for this morning. Okay. All right, behave.
You can double click on it sometimes too, okay?
Well, I'm trying.
Page
some
up.
days, yeah. Some days it works well with that, and some days it doesn't. And today it is not. Okay. It's just okay. Signature trades, all trades and observations must be made in context. That is what I was trying to explain this morning. The single prints and the single prints and the volume were an awful lot of the context. And what we say is everything. And
the way it went down, Jim, that it was sluggish, timid.
The tempo was slow.
Yeah.
Okay. Everything is a series of facts surrounded by other circumstances. It is the other circumstances that allows the fine-tuning and allows you to compete. I'm going to talk later. I was talking to somebody last night that's in the military, and I was reminded when I was in the service on the fitness report, they had something called attention to detail. And attention to detail is extremely important. When you're competing against as many people as you are and as competitive as this marketplace is, detail is very important. Okay, here's some of the list. Overnight inventory adjustment, break out of range and accelerate, look above or below range and fail. We just saw that. Profile balance, area breakouts and breakout failures. And remember, excess and balance, two most important concepts we ever deal with. What you saw was look below balance today, but you also could have 2 or 3 30-minute bars that give you balance in the during the daytime frame profile. Breakout from that is treated exactly the same way as we would treat a breakout or a failure from a 2-month or a 2-week or a 2-day balance. The concepts work the same in all time frames. Getting on a potential developing trend day using a 30-minute bar to fade a single tick failure. What we're talking about here is, let's say you have a trend day down, and all of a sudden the market goes up and it looks 1 tick above the last 30-minute bar. It's a classic that when you see that, sometimes you'll get selling coming in. You'll have daytime frame traders and short-term traders just waiting for that spot to enter the market, and they will sell very heavily. What happens on those, that is what I call here today and gone tomorrow. It's a good reference today, but usually that's an indication that it was weaker selling, even though it may go down substantially. We normally will take those back, and we'll talk about that a little later.
Which is a theory of weak highs and weak lows again.
Yes, it is.
Same thing. Put words to it.
We talked earlier, trending pattern, poor highs, poor lows, potential repair. Like we said, on a trend day up this morning, you get a poor high. On a trend day up, normally that poor high is temporary. The market pulls back, and the poor high allowed a little inventory adjustment. Then the market comes back and takes it out. Okay, we're just basically...
One more page.
It's hard for you to follow this without real examples in front of you. I'm just trying to give you a flavor, because we're going to go into a couple more examples here. Pit session inventory getting out of balance, automatic buying or selling off of a major reference. Day time frame trading is so much dependent upon inventory getting in or out of balance. Inventory, when you've got weaker traders in the market, which what happens when you've got, pit session inventory? The weaker traders get the market too long, they get it too high. You'll see they'll get it too long or too short. It's constant. It goes on all day long. Automatic buying or selling off of a major reference. We see that, and we're going to look at another example of that, because that is something that may be a good opportunity for a quick trader. It may be good for one time frame, weak for the next time frame. But you need to see real examples for that. Pit session inventory getting out of balance, automatic buying or selling. It brings me to a point. I'm going to escape here for a second. I'm going to go to yesterday, and I'm going to show about a short-term trade. Let me see if I can spread yesterday out a bit. Yesterday afternoon, in the market was sitting right around unchanged for a considerable period of time. And you can see there was unchanged. The market came back in G period, and it just set at unchanged. The green arrow here is unchanged. So we looked lower, F period, G period came down, sitting exactly at the unchanged level. Now keep in mind, We'll see this again later, but the market was selling off yesterday. Saw the market selling off all day long.
From a gap.
From a gap, we're going to talk about a little bit later, but from a gap, we sold off. Trend was down. We're back into the previous day's range. The destination trade is to yesterday's low. We don't know if we'll get there. But right here, when the market set it unchanged in G period, after being A, B, C, so you 1, 2, 3, 4, 5, this is the 7th period, and it's just sitting at unchanged. What I saw at this time is I was looking for an opportunity to get short again. And what I was looking for was an inventory adjustment rally. You got the rally. It came off of unchanged. It rallied in the next period. It got just short. It was just short of the E period high, H period high, and it would have been round half back at that point in time. And then the market came back and gave you that opportunity. So remember, yesterday we had a gap. We filled the gap. We re-entered the previous day's range. The trend was down. Volume yesterday morning was higher than the previous day, and this did not feel like it was over, but what it felt like is that inventory had just gotten too short. And this is what we see so often when the market then made a short covering rally, and this happened very, very quickly. Again, another indication of old business, happened very quickly, set up here for a little bit of time, but this was your daytime frame opportunity to get short in the direction in which the market was traveling for yesterday. Okay, I just wanted to show that because we were talking about inventory adjustments. I remember the trade. I just wanted to show an example of what happens when you are paying attention and you are present in the market. You could have sat there. It was 2, 3, what was it? 1, 2, 3, 3.5 hours. And it sat down in this area for an hour and a half. And all of a sudden, there was the opportunity. Sometimes they come up very quickly. Okay, I'm going back to the slides. Signature trades, we're going to look at the 45-degree pattern, spikes, gaps. These are all signature trades. We can't talk about them all today. We saw a 45-degree line last Friday.
We'll get to that.
Told us the market was short. But now let me go and let's make this real. One of the most important signature trades, and it's important because it happens, we deal with it every day, it's overnight inventory adjustment. Approximately 65% of the time, we will see a counter auction relative to what overnight trade has done. Remember earlier, I talked about context, said everything's a series of facts surrounded by other circumstances. You have to understand the context. You can't just blindly say overnight inventory is long or short, it's going to adjust. You have to look at the context for it. So we'll start this example from Thursday, April 17th and follow through to Tuesday, April 21st. Overnight, and we're going to talk the overnight inventory, 45-degree lines, breakout in range, and fail. There's all considerations. Okay. We look at Friday. Market comes into Friday. At the end of Friday, we have the 45-degree line. The 45-degree line occurs when the point of control, which is also considered the fairest price at which business is being conducted, is followed, continually followed by the market trading lower. Traders are getting short in the hole. Now, you've seen this example before. We talked about this the other day. It's just a refresher because not everybody that was on the other day is on today. This tells me that the odds are very good that traders are short in the hole. Short in the hole simply means short at bad prices. And by that, when I translate, that means they are short at prices below value. Now, a lot of people get mistaken. They say, well, we had a rally late Friday afternoon. Doesn't that allow the shorts to cover? The answer is no. This happened too quickly. The chances are highly unlikely they all got covered. So part of the context coming into Monday is going to be that this market is probably very short coming into Monday. Secondly, we talked about this before. This was the situation where we had 5 clustered high. Short-term traders selling mechanically at this level. We said earlier, one of the things you'll have happen when you have short-term traders selling is they will mechanically sell at previous 30-minute highs. They sold F period 1 tick below E period. They sold G period 1 tick below F period. They sold H period exactly at the G period high. When I see that, I know that that is weaker selling. Long-term money has no idea what those numbers are, nor do they care. This is weak hand selling. As we talked about one of the signature trades, and this took a long time to develop, it looks 1 tick above or right at, and then the market broke. And you see that market did break. Now, there's another signature trade is here too. You have 1, 2, 3, you have a 4-period balance. Okay? One of the signature trades. The 2 most important concepts we deal with are excess and balance. Here is a 2-hour balance or 4 30-minute periods. There's the breakout from balance. The breakout from balance is, balance trading rules apply. Either break and go or fail. If it fails, then the destination trade becomes the opposite extreme. This was a breakout from balance. Now, it's a short-term trade. With these other things in here, I don't think it's going to be lasting. And it didn't. It came back. But it was a great trade for a short-term trader that was present in the market. So now we finally got the break below value. Short trap is set. 12-point rally into the close. But not enough to have covered all of the shorts. Remember, they were selling short from the early morning. So now as we come into Monday, we have that background. Overnight inventory is long. So as we come into Monday morning, there is the settle 20, 70, 75, 50 is the settle from Friday. The market is long, inventory is long coming into Monday, and the market does not correct. You get a little selling early on, but it never gets down back to where these clustered highs were. What happens when the market opens higher like this on Monday? I'm sorry, that's not the opening. I'm sorry. This is the overnight inventory. Overnight inventory is 100% long. There is the settle. 100% is long. Now we talk about the idea of a 65% chance we'll get a counter auction. When you look at the context, remember we thought the market was short coming in to Monday. When the market opens above these clustered highs, that's where the heavy shorts were. These shorts do not get covered in the overnight market. Sure, some of the shorts will have covered in the overnight market, but it is highly unlikely that a lot of these traders covered. They don't deal in the overnight market. They wait until the following day. And remember, a lot of these shorts are the results of stock traders being short, and stock traders do much less trading overnight than futures traders do. So the stock traders are short. They're going to drive the futures. So when the market opens higher on Monday, the first order of business the first order is business is all of these shorts that got caught from Friday have to buy the cover. They'll get margin calls, or their firms are forcing them out of the trades because of margin calls. So that context was extremely important on coming into Monday. So we did not see a correction of overnight inventory. One of the other rules that we talk about with overnight inventory, if the market is short and it does not correct, that is a sign of strength, at least on a short-term basis. So that's what happened Monday. What you'll see on Monday, we have a classic P formation up there. So again, somebody asked earlier, define old business versus new business. If I had a combination, a more healthy combination of short covering and new money buying, it is highly unlikely that I am going to get the classic P formation that demonstrates old business or short covering. This is just old business. They have to cover. It also sets the tone for the day. If I had a combination of old business and new business, it is highly unlikely that I'm going to get a truncated market such as this.
You get more elongation in the profile. Initiative buying would be pushing the profile higher. It wouldn't be fattening out and going sideways. It would be going higher, and the profile would remain relatively thin, 4 or 5 prints wide, and be elongating. Excuse me, just wanted to clarify.
No, that's absolutely right. Okay, now, notice that B period came down and exactly touched the halfway level.
Overnight high.
I'm sorry, exactly touched the overnight high. So the break in B period was exactly I guess it's 1 tick above the overnight high. You've heard this concept over and over. That is a sign of a weak pullback. Now, the question was asked the other day by a professional trader in Minneapolis, can I buy that? Of course you can. But what the answer was, you can buy this, and sometimes it's a very good buy. But it's only for the trader that's very nimble. You got to be out of this trade. If it doesn't work, you're out very quickly. But this is a classic pullback, particularly in markets are short. They have to cover the short. That's about the best they get. They're looking at mechanical reference. Anytime a market goes to mechanical references, more than likely, you are looking at short-term, weaker hands trading. Okay?
And Jim, if I may interject, we had a question earlier in this webinar. The B period high, when exactly on Tuesday, in Tuesday's market, April 21st, the B period high went exactly to Monday's high before the market sold off. And we're seeing that being repaired right now as we speak. So it's an inverse, and it's just a day later. So it did play out this same theme if you look at the B of Tuesday's high to Monday's high, and today how we've come back to get at that after the break.
Now, when I take this, when I do my analysis at the end of the day, and I'm looking at Monday, and I really want to know, is Monday weak or strong? Well, the first thing you say, well, Jim, it's pretty strong. Value is clearly higher. That's absolutely, that goes in the positive category. Now, in the negative category, I look and I see, okay, let's see all these single prints and how truncated or fat the market got above this. Negative. Remember, short covering does what? Short covering weakens a market because it removes potential buying power. I also know that I didn't have new buying, or I would have had more elongation, as Julia said, been 4 or 5 wide. So coming back to this exact reference in B period as an indication of a market that really was day and short-term trading, not longer, more serious money. The fact that the market wasn't elongated. And next, we will find that the volume on Monday was under 3 billion on the NYSE composite.
We showed that. Yep, on the first.
That's about as low as we get in there. So now, coming into Tuesday, I'm looking, and I'm not very excited about upside continuation because Monday was such a weak day. And I carry all these observations forward. Now, I had a couple of traders, people I'm fairly close to, that were really frustrated about Tuesday and what happened. I said, well, if you've got to go back and look and see what happened before. What happened before tells us an awful lot about the future going forward. And the analogy I've used over the years, it's very similar to counting cards in blackjack. What has been played before has an awful lot to say about the odds going forward. Okay, now come into yesterday. So we gap open yesterday. Gap open, and that's a serious trade. It's a serious trade. So overnight inventory is long. Overnight inventory is long yesterday. And my inclination is to short the gap and short overnight inventory based upon Tuesday's profile or Monday's profile. I have a very prominent point of control down here, and I also have another prominent point of control from Friday that has not been revisited. So I have two prominent points of control have not been revisited. So my inclination is to fade the overnight inventory. Now, let's go back for a second. I did not want to fade overnight inventory on Monday because of the context. I thought Friday was too short, and that played out. I did want to fade overnight inventory yesterday because Monday's profile looked so poor to me. Now, the market opened. There is the opening price. The market opened exactly at the opening, and it rallied and came back to that 3 times before it broke, exactly to the opening. When it came exactly to the opening and bounced the second time, I shorted the market. And Julia and I, we knew we both shorted the market. I shorted here. Julia shorted when it broke down below this level. But when I'm looking and I'm saying I already had an inclination to short, I was watching very closely. The mechanical going exactly 3 times, I did it after the second time, bounced from exactly the opening, told me that all I had buying in there was very weak hands, mechanical buying that are just blindly buying at the opening price. Okay, now, but the point I wanted to make here is the difference in context relative to what. So one day on Monday, the overnight inventory did not correct. On Tuesday, the overnight inventory did correct. What is important is how different the context was. People I talked to that were frustrated by yesterday, and some by Monday, I found that they really had not thoroughly prepared and had thoughts about the market coming in. Some of them just looked at, well, value is higher. And value is very important, but it's only one piece of information. Okay, so that, and we said we had the prominent points of control. So that's what we wanted to talk about. I mean, there's a lot else, other things that went on, but it really was that overnight inventory is one of the prominent signature trades we have because it happens every single day. And it's like everything else we do, context is so very, very important. Okay, as we wind this up, we'll take a few questions, but let me cover this first. Remember, the intensive, it starts on June 1st, but if you sign up early, starting May 1st, you get the 2 daily reports. You saw this morning the example of a report that could have been very meaningful today. And so you get the morning report, and at the end of the day, you get the S&P recap and preparation report. Monday's report, the weekend report, this for Monday, would have discussed the shortness of Friday's market. Also, starting May 1st, I will have the real-time market chat comment. It's a one-way thing. You pull it up, and I make chat comments throughout the day. And I try and keep them tight and to the point. The reason they're only one way is because a lot of traders don't want to look at what other people's comments have to be. It clutters it up. You have questions, you come in via email. But this way it's how I'm seeing the market, sometimes right, sometimes wrong, but it's the market generated information we're looking at. You have immediate access to 2 most recent intensives, and over 100 trading articles and separate webinars. Question and answers throughout the intensive for traders. Separate sessions, right? So I do a webinar almost every day during the intensive. But also, what happened last time, Julia does a separate webinar following mine that is for newer traders, or traders that aren't advanced in the process, and we can't answer all the beginning questions on the webinar that I do. Julia's session was a tremendous hit and got tremendous participation. As I mentioned the other day, I was actually getting a little jealous when I saw the amount of participation she was getting. I knew my days were limited. And starting June 1st, it's about 11 hours a week of sessions that I'm live. Okay, Julia, let's take some questions remaining from what we've discussed today, and I'm also going to go back and put the current market up in front of us. Okay?
And just a comment, I'm just trying to answer questions here. The morning report comes out at 9 a.m. or thereabouts, and the evening reports comes out after market. It depends.
Sometimes the evening reports don't come out till 10 or 11 o'clock Eastern time.
Rarely that late, but sometimes they do. Sometimes they're right after. It depends. But Jim, right here we've got the F period came exactly down. That's why the breakout rules, you want to be careful not to try and get in this too early because it would have chopped you out. But the F came down to D and E, so I would imagine that makes that reference, even weaker. You were saying you thought it would be revisited before the day is done.
So this is very weak, 3 periods. It's just this weak up here.
Yeah.
So what we had short covering this morning, but we again have had no indication of new money participation in this market.
There's a lot of volume there too, Jim.
I want to go back and look. This is the bar chart, and this is 37. This is the 38th day, I think. I'm starting from right here. This market is a lot of chop. That's a lot of chop, a lot of confusion, and not a lot of conviction. Very, very dangerous and to some frustrating environment. It's not frustrating if you don't try and make more out of it than is really there. Okay, other questions? So right now, before we leave, this range is unlikely. It wouldn't surprise me if both ends of this were tested today. But no matter what happens, this is not going to turn out to be a strong day. We got short covering, but we're not seeing the new money buying in this market. And that doesn't mean we don't take this out and extend, but it's not a particularly healthy day. Okay?
Yeah, but the poor high, can you collapse your profile from yesterday and move your chart over to the right so we can see more of what we're looking at from prior? So we have that fat POC over, if you move it over more to the right, we got plenty of room on, yeah, so we've got that, another prominent, well, it was repaired already, I beg your pardon, that A period.
It was repaired yesterday.
But, okay, but certainly it's this volume here, we use the volume too as, it's a dynamic reference, but it can act as support or resistance, and there's a lot of volume in here. It can't seem to break above it. It looks like it's getting too long. But let me see here.
It's getting too long, and yet there's no completion. It's a very complex situation. Nothing going on in here.
Right. Monday also had a cluster high at the high, like Friday. Wouldn't this have been an important consideration? And if you look at Jim right there, 420, you point to it, yes, and it's back there today. So it wasn't it was a weak selling reference.
It was, but that was all taken out on,
or yesterday, right, for the gap.
This is, again, they were shorting here. They were shorting here, and you see what they did? They got caught again. The short-term traders got caught again. They were short selling the market, in all day long at this, just below the mechanical selling, just below the high all day long, and they got hurt again. It happens over and over again. But what is important is that you can differentiate. Like I said yesterday, if you were with us, a really good trader has a positive understanding of cognitive dissonance. Generally, cognitive dissonance, we say, is a killer. You know, you have a negative and a positive in your mind, and it just messes you up. But when you're an experienced trader, cognitive dissonance can be very positive. You can sit there and say, I don't think this market's completed for going forward, but I do think it's completed today. So in one aspect says, I think we're going higher. The other aspect, I think we're going to go lower. And that's very positive. When you can become a very powerful trader, when you can hold two conflicting thoughts in your mind. Generally, they will have a slightly different time frame to them. But that's very positive when you can. So many times people want everything to be black and white. Well, is it going up or is it going down, Jim? And when I answer, well, the odds are pretty good that we're not going to go up much more. They don't like that answer. But again, it's a very positive thing. Thank you for pointing that out. It's a great point. Okay, a couple more questions before we sign off.
Is Jim hanging on to his long calls?
Jim let go of 50% of his long calls, and
they were 2090s. What were they, Jim?
They were 2095s.
95.
And they're now trading at 850, 8 bid, 850 offered. I paid $440 for them, and I'm now short equal number of futures against the calls. Once they got up in the money, and it's just a 50-50 hedge at this point in time. And so I don't know what I'm going to do. I probably would have been all out if I wasn't on the program here, but I let half of them go while we were doing the program, and the others hedged. The others are hedged. Okay, another couple of questions.
Jim isn't planning a webinar on how he trades options. At the intensive site, you've been in it a few times. We have 2 option sessions that we keep available and up there, but clearly this process in itself is complicated. To try and trade options with Jim, 40 years of trading options, being a principal, one of the people starting the Chicago Board Options Exchange, he's not trading Greeks, he's not trading numbers. It's very, it's hard for him to explain, and really, if you understand this process first, then you can start to apply it by, doing options, trading options. But one can't come before the other. If you get into the world of options without understanding this, you're only diluting and distracting, or, bifurcating your attention and your focus.
Options add huge levels of complexity to the mental processing. Okay, another couple of questions.
The market, well, we talked about this, but let's go over it. The market is spending a lot of time up here near the top. What does that tell you?
It tells me that I've got short covering. I don't have new business, and
there's no completion.
There's no completion. This market, it's just a terrible market. We're right back to I actually thought we might get some excitement out of this. When it looked below this, when it looked down below, I said, wow, we might have something. And you have to constantly adjust. They're selling this market again right about here. So,
Right here, what is here? Okay, at the 29.
Right at the highs. Yeah, I mean, it's just, there's nothing here. And the worst thing you do is try and make something out of something that's not there. If I keep showing back for 37, 38 days, this market has gone nowhere. And it's just back and forth, tremendous amount of confusion. And there were some nice trades early this morning. Saw several early trades this morning. I've seen nothing now for the last couple of hours. Okay, let's say thank you very much. We would love to have you join us with the intensive, and I'd love to see you benefit from the reports as well as the chat comments. And once again, Julie and I thank you all very, very much.
Okay, great. Thank you, Jim, very much. Our next webinar is Monday, and then we'll have another one on Wednesday. So check out, if you're interested, resources, webinars, upcoming webinars, and you can register for all of those. Thank you very much, Jim, and thank you, everyone, for hanging in there and being here. It's great to have you all. We had some fabulous questions, so thanks for your participation. We will have this recording up in about an hour. Okay, thank you very much. Have a great afternoon. God be with you. Bye-bye.